Hello, I'm SA, your AI essayist. Please note that all content, audio and video in this presentation are AI generated. As AI can sometimes produce inaccuracies, I encourage you to verify any factual information presented. With that in mind, let's begin. Before Peter Lynch, the world of investing often appeared as an exclusive domain, shrouded in complexity and reserved for financial professionals. The average individual, facing a labyrinth of market jargon, intricate financial statements, and sophisticated analytical tools, could easily feel excluded. Investing seemed a game best left to those with specialized knowledge and access to privileged information. The financial landscape of the 1970s and 1980s presented a stark contrast between the individual investor and the institutional giants, creating a perception of inherent disadvantage for those outside the inner circles of Wall Street. Lynch's career trajectory began at Fidelity Investments, where he demonstrated an early aptitude for identifying promising investment opportunities. Even in the nascent stages of his career, his initial investment strategies hinted at the unconventional approach that would later define his success. The Magellan Fund, under his stewardship, quickly became a standout performer, capturing attention and generating substantial returns. This early success was a harbinger of the transformative impact Lynch would have on the investment world. At the heart of Lynch's philosophy lay a deceptively simple principle: invest in what you know. This approach represented a significant departure from the prevailing Wall Street wisdom, which often emphasized complex quantitative models, macroeconomic forecasts, and reliance on expert opinions. Lynch championed a more intuitive, bottom-up approach, encouraging individuals to leverage their everyday experiences and observations as a source of investment insight. The traditional investment landscape presented numerous challenges for the individual investor. Institutional investors, armed with vast resources and teams of analysts, possessed a significant advantage in accessing and interpreting financial information. Moreover, the complexity of financial analysis often served as a barrier, intimidating those without formal training in finance or accounting. The perception was that successful investing required specialized expertise and access to proprietary data, effectively excluding the average person from participating meaningfully in the market. Lynch's invest in what you know philosophy offered a solution to this problem. By focusing on companies and industries that were familiar to them as consumers or members of their local communities, individuals could gain a valuable edge. This approach allowed them to bypass the need for complex financial models and instead rely on their own first-hand experiences and observations to identify potentially undervalued companies. If one consistently patronizes a particular establishment or recognizes a novel product's popularity, this first-hand exposure becomes a valuable indicator of the company's potential. Lynch's investment approach wasn't simply about buying stocks based on hunches or gut feelings. It involved a disciplined process of research and due diligence, but one that prioritized understanding the fundamentals of a business and its competitive landscape. He emphasized the importance of visiting stores, talking to customers and employees, and gaining a deep understanding of a company's products, services, and management team. This grounded approach allowed him to make informed investment decisions based on real-world observations rather than relying solely on abstract financial metrics. While Lynch is primarily celebrated as an investment manager, his contributions extend far beyond simply generating returns for his fund's shareholders. His accessible communication style and clear articulation of his investment strategies played a crucial role in democratizing the world of investing. Through his books, articles, and public appearances, he demystified the investment process and empowered individuals to take control of their financial futures. He provided a framework that allowed ordinary people to participate in the stock market with confidence, armed with the knowledge and understanding necessary to make informed decisions. His emphasis on common sense and practical experience resonated with a broad audience, transforming the perception of investing from an exclusive club to a more inclusive and accessible activity. The impact of Lynch's approach can be seen in the rise of retail investing and the increasing participation of individuals in the stock market. He helped to break down the barriers that had previously excluded many from the world of finance, fostering a greater understanding of investing principles and empowering individuals to build wealth for themselves and their families. His legacy extends beyond the impressive performance of the Magellan Fund. It lies in the lasting impact he had on investor education and the democratization of the financial markets. He showed that success in investing is not solely dependent on complex algorithms or insider information, but rather on a combination of common sense, diligent research, and a willingness to learn from one's own experiences. The accessibility he championed continues to shape the way individuals approach investing today. Lynch's democratization of finance extended to his core investment philosophy, a principle encapsulated in the simple yet profound phrase, "Invest in what you know." This wasn't a mere slogan. It was a carefully considered strategy designed to empower the individual investor, leveraging their unique perspectives and everyday experiences to identify potentially lucrative opportunities often overlooked by Wall Street. At the heart of this approach lay a recognition of the problem of information asymmetry, a persistent challenge in the stock market. Institutional investors, with their vast resources and sophisticated analytical tools, typically possess an informational edge over individual investors. They have access to proprietary research, industry experts, and advanced trading platforms, creating an uneven playing field. Lynch sought to level this field, arguing that individual investors, by virtue of their daily lives and consumer experiences, held valuable insights that could translate into successful investment decisions. His philosophy encouraged individuals to pay close attention to the products and services they used, the businesses they frequented, and the trends they observed in their local communities. Was a particular store always crowded? Was a new restaurant generating significant buzz? Was a specific product flying off the shelves? These seemingly mundane observations, Lynch argued, could provide valuable clues about the underlying strength and growth potential of a company. Consider, for example, a scenario where an individual consistently notices long lines at a specific coffee shop chain in their city. This observation, while seemingly insignificant, could indicate strong customer loyalty, effective marketing, and a superior product offering. Further investigation, through publicly available financial reports and industry analysis, might reveal that this coffee shop chain is expanding rapidly, increasing its market share, and generating impressive revenue growth. Armed with this information, the individual investor could make a well-informed decision to invest in the company, potentially benefiting from its continued success. Another example could involve a local retailer specializing in a particular niche, such as outdoor gear or organic food. If an individual observes that this retailer consistently offers high-quality products, provides excellent customer service, and cultivates a loyal customer base, they might consider investing in the company, especially if it has plans to expand its operations or enter new markets. The individual's first-hand experience as a customer provides a valuable perspective that complements traditional financial analysis. These examples illustrate the power of Lynch's "invest in what you know" philosophy. It encouraged individuals to view their everyday experiences as potential sources of investment ideas, transforming them from passive consumers into active participants in the financial markets. It empowered them to leverage their unique knowledge and perspectives to identify undervalued companies with strong growth potential. Lynch's approach stood in contrast to the traditional financial analysis techniques prevalent at the time. Wall Street analysts typically relied on complex models, such as discounted cash flow analysis and earnings per share ratios, to evaluate investment opportunities. These models, while sophisticated, often required specialized knowledge and access to proprietary data, making them inaccessible to the average investor. Discounted cash flow analysis, for instance, involves projecting a company's future cash flows and then discounting them back to their present value to determine its intrinsic worth. This requires making assumptions about future growth rates, discount rates, and other variables which can be highly subjective and prone to error. Similarly, earnings per share ratios, which measure a company's profitability on a per-share basis, can be easily manipulated by accounting practices and may not accurately reflect the company's underlying financial health. Lynch, while acknowledging the value of these traditional techniques, emphasized the importance of common sense and practical experience. He believed that individual investors could gain a significant edge by focusing on companies they understood and whose products or services they used regularly. This approach simplified the investment process, making it more accessible to non-experts and empowering them to make informed decisions based on their own observations and insights. He wasn't advocating for abandoning financial analysis altogether. Instead, he proposed a complementary approach, one that combined traditional methods with a healthy dose of common sense and real-world experience. He encouraged investors to do their homework, research the companies they were interested in, and understand their business models. However, he also stressed the importance of trusting their own instincts and leveraging their unique perspectives to identify opportunities that others might miss. The modern relevance of Lynch's "invest in what you know" philosophy is undeniable, particularly in the age of readily available online information and the rise of retail investing. The Internet has democratized access to financial data, making it easier than ever for individuals to research companies, analyze their financial performance, and stay informed about industry trends. Online brokerage platforms have also lowered the barriers to entry for individual investors, allowing them to buy and sell stocks with ease and at low cost. This has led to a surge in retail investing, with millions of individuals now participating in the stock market. Social media platforms have further amplified this trend, providing a forum for investors to share ideas, discuss investment strategies, and learn from each other. In this environment, Lynch's "invest in what you know" philosophy is more relevant than ever. Individual investors have access to a wealth of information and a growing community of fellow investors, empowering them to make informed decisions based on their own knowledge and experiences. They can leverage their understanding of consumer trends, local businesses, and emerging technologies to identify undervalued companies with strong growth potential. The rise of e-commerce, for example, has created new opportunities for individual investors to identify successful online retailers and brands. By tracking website traffic, analyzing customer reviews, and monitoring social media engagement, investors can gain valuable insights into the performance and popularity of these companies. Similarly, the growth of the sharing economy has created new investment opportunities in companies that facilitate peer-to-peer transactions, such as ride-sharing services and home rental platforms. However, it's important to acknowledge that Lynch's philosophy is not without its limitations. It requires discipline, patience, and a willingness to do one's homework. It also requires a certain degree of skepticism and a willingness to challenge conventional wisdom. Investors should always be wary of hype and avoid making impulsive decisions based on limited information. Furthermore, the "invest in what you know" philosophy can be particularly challenging in certain industries, such as biotechnology and pharmaceuticals, where specialized knowledge and scientific expertise are essential. In these cases, it may be necessary to rely more heavily on traditional financial analysis and seek the advice of industry experts. Despite these limitations, Lynch's invest in what you know philosophy remains a valuable tool for individual investors, empowering them to leverage their unique perspectives and everyday experiences to identify potentially lucrative investment opportunities. It encourages them to view the world around them as a source of investment ideas, transforming them from passive consumers into active participants in the financial markets. It is a philosophy that continues to resonate with investors today, inspiring them to take control of their financial futures and build wealth for themselves and their families. Peter Lynch's influence extends far beyond specific investment strategies. A significant aspect of his legacy resides in his exceptional ability to communicate complex financial concepts in a clear, accessible manner. Through his best-selling books, One Up on Wall Street and Beating the Street, and his engaging public appearances, he demystified the world of investing for a broad audience, empowering individuals to take control of their financial futures. Prior to Lynch's popularization of investing, a significant portion of the population felt intimidated by the stock market, perceiving it as an exclusive domain reserved for financial professionals. Financial jargon and intricate analytical techniques created a barrier to entry, leaving many individuals feeling unqualified to participate. This widespread financial illiteracy hindered wealth creation and perpetuated a sense of dependence on financial institutions. Lynch addressed this problem head-on by translating complex financial concepts into everyday language. He stripped away the unnecessary complexity, focusing on fundamental principles that anyone could understand. His explanations were relatable, practical, and grounded in common sense, making investing seem less daunting and more achievable. He emphasized the importance of understanding a company's business model, its competitive advantages, and its financial health, rather than relying solely on abstract financial metrics. A key element of Lynch's communication style was his use of analogies, metaphors, and real-world examples to illustrate complex concepts. He frequently drew upon his own experiences as an investor and his observations of everyday businesses to explain how the stock market works. For instance, he might compare investing in a company to buying a piece of a local business, emphasizing the importance of understanding the product or service being offered and the company's prospects for future growth. These relatable examples made it easier for readers to grasp the underlying principles of investing and apply them to their own situations. One Up on Wall Street and Beating the Street became runaway bestsellers, transforming the way people thought about investing. They presented a refreshing alternative to traditional financial reporting, which often focused on short-term market fluctuations and complex technical analysis. Lynch's books emphasized the importance of long-term investing, fundamental analysis, and a patient, disciplined approach. They encouraged readers to conduct their own research, make their own investment decisions, and avoid being swayed by market hype or fear. The impact of Lynch's books on popularizing investing cannot be overstated. They inspired a generation of individual investors to take a more active role in managing their finances. By providing them with the knowledge and confidence to make informed investment decisions, he empowered them to participate in the stock market and build wealth for themselves and their families. He effectively democratized investing, reducing the barriers to entry for average people and leveling the playing field between individual investors and institutional investors. Consider the typical financial reporting of the time. It often involved complex charts, graphs, and technical indicators that were incomprehensible to the average person. Financial news programs frequently featured analysts making predictions about short-term market movements, creating a sense of urgency and encouraging speculative trading. This type of reporting often left individual investors feeling confused and overwhelmed, reinforcing the perception that investing was a complex and risky endeavor. Lynch's approach was distinctly different. He eschewed technical jargon and short-term predictions, focusing instead on the fundamentals of investing. He emphasized the importance of understanding a company's business model, its competitive advantages, and its financial statements. He encouraged investors to take a long-term perspective and avoid being swayed by market noise. This simple, straightforward approach resonated with a broad audience, making investing seem accessible and achievable. His historical significance lies in his role in reducing the barriers to entry for average people into the stock market. He demystified the world of investing, providing individuals with the knowledge and confidence to take control of their financial futures. His accessible communication style, his emphasis on fundamental analysis, and his encouragement of long-term investing transformed the way people thought about the stock market and inspired a generation of individual investors. He shifted the focus from speculation and short-term gains to long-term value creation, empowering individuals to build wealth and achieve their financial goals. This was a departure from the traditional, often exclusive, world of finance, making it more inclusive and accessible to everyone. Peter Lynch's approach fundamentally altered the landscape of personal finance. He fostered a sense of empowerment among individual investors, enabling them to navigate the complexities of the stock market with greater confidence and understanding. His legacy continues to influence the way people approach investing today, especially with the rise of online trading platforms and social media-driven investment trends. The next discussion will consider any criticisms of Lynch's investment philosophy, such as its potential limitations in rapidly changing markets or its susceptibility to behavioral biases. Peter Lynch's communication style proved as significant as his investment acumen. He possessed a rare ability to distill complex financial concepts into easily digestible language, making the stock market less intimidating for the average person. His books are filled with relatable anecdotes, clear explanations, and practical advice, demystifying Wall Street and empowering individuals to take control of their financial futures. He spoke in plain English, avoiding jargon and technical terms that often alienate novice investors. This approach fostered trust and encouraged participation, transforming the perception of investing from an exclusive club to an accessible opportunity. His emphasis on common sense and fundamental analysis resonated deeply with a broad audience. He championed the invest in what you know philosophy, encouraging people to look for investment opportunities in their everyday lives. This approach made investing more tangible and relatable, empowering individuals to leverage their personal experiences and knowledge to make informed decisions. It also highlighted the importance of understanding a company's business model, financial statements, and competitive landscape, promoting a more disciplined and long-term investment approach. Lynch's accessible communication style extended beyond his writing. He actively engaged with the public through television appearances, interviews, and public forums, consistently delivering his message with clarity, enthusiasm, and a genuine desire to educate. He possessed a natural ability to connect with people from all walks of life, fostering a sense of community and shared purpose among individual investors. Despite his widespread popularity and remarkable track record, Lynch's investment philosophy has faced scrutiny. One common critique centers on its potential limitations in rapidly evolving markets. The invest in what you know approach, while intuitive, may not always be sufficient in sectors characterized by rapid technological advancements or disruptive innovation. These areas often require a deeper understanding of emerging trends, complex technologies, and evolving competitive dynamics, which may extend beyond the scope of everyday experience. Another potential drawback lies in its susceptibility to behavioral biases. The tendency to favor familiar companies or products can lead to concentrated portfolios and a lack of diversification, increasing risk. Furthermore, emotional attachments to certain brands or industries can cloud judgment and lead to irrational investment decisions. While Lynch emphasized the importance of fundamental analysis, the inherent human tendency to be influenced by emotions and personal preferences can still undermine even the most well-intentioned investment strategies. The potential for oversimplification also warrants consideration. While Lynch's accessible communication style undoubtedly democratized investing, it may have inadvertently led some individuals to underestimate the complexities of the stock market. Investing involves inherent risks, and success requires a combination of knowledge, discipline, and careful analysis. A superficial understanding of a company or industry based solely on personal experience may not be sufficient to make informed investment decisions. Thorough due diligence, including a comprehensive review of financial statements, industry trends, and competitive dynamics, remains crucial for long-term success. Furthermore, Lynch's emphasis on individual stock picking may not be suitable for all investors. Building a diversified portfolio of individual stocks requires significant time, effort, and expertise. Many investors may find it more efficient and effective to invest in diversified mutual funds or exchange-traded funds, which offer instant diversification and professional management. While Lynch's approach empowered individuals to take control of their investments, it also placed a greater responsibility on them to conduct thorough research and manage their portfolios effectively. Synthesizing Lynch's contributions reveals a dual legacy encompassing both investment strategy and investor education. His investment philosophy, characterized by a focus on fundamental analysis, long-term value creation, and the invest in what you know principle, generated exceptional returns and inspired a generation of individual investors. Simultaneously, his accessible communication style, marked by clarity, enthusiasm, and a genuine desire to educate, demystified the stock market and empowered individuals to take control of their financial futures. These two aspects of his work are inextricably linked, each reinforcing the other to create a lasting impact on the financial landscape. Peter Lynch's enduring legacy lies in his role in democratizing investment and empowering individual investors. He transformed the perception of the stock market from an exclusive domain accessible to only a select few into a realm where anyone, regardless of their background or experience, could participate and build wealth. He instilled a sense of confidence and self-reliance in individual investors, encouraging them to trust their own judgment and make informed decisions based on their own knowledge and experiences. His accessible communication style played a pivotal role in this transformation. By demystifying complex financial concepts and speaking in plain English, he broke down the barriers that had previously excluded many individuals from the world of investing. He showed that investing did require advanced degrees or specialized knowledge, but rather a willingness to learn, a common-sense approach, and a long-term perspective. The invest in what you know philosophy, while subject to certain limitations, proved remarkably effective in empowering individuals to identify investment opportunities in their everyday lives. It encouraged people to pay attention to the products they used, the services they consumed, and the companies they encountered in their communities, fostering a deeper understanding of the business world and promoting a more engaged and informed approach to investing. His influence continues to shape the way people approach investing today, especially in light of the rise of online trading platforms and social media-driven investment trends. While these platforms have made it easier than ever for individuals to access the stock market, they have also created new challenges, such as the proliferation of misinformation and the temptation to engage in speculative trading. In this environment, Lynch's emphasis on fundamental analysis, long-term value creation, and the importance of due diligence remains as relevant as ever. His legacy serves as a reminder that successful investing requires a combination of knowledge, discipline, and a long-term perspective. It encourages individuals to resist the allure of quick profits and focus on building a diversified portfolio of high-quality companies that can generate sustainable returns over time. It also underscores the importance of continuous learning and adaptation as the financial landscape continues to evolve and new challenges emerge. Ultimately, Peter Lynch's contribution extends beyond his impressive investment track record. His true legacy resides in the countless individuals he empowered to take control of their financial futures, build wealth, and achieve their financial goals. He fundamentally altered the landscape of personal finance, making it more inclusive, accessible, and empowering for everyone. We really appreciate you tuning in to this AI-powered presentation. Our goal is to push the boundaries of AI in content creation, and your input is invaluable. If there's a particular subject you'd like to see us tackle next, or if you have suggestions on how we could fine-tune our AI's creative prompts, please don't hesitate to leave your ideas in the comments section. We're excited to bring you more unique content very soon.